All right, ladies and gentlemen, very warm welcome to our actually not live trading today, but our futures course. Today is, what is today? Today is Monday, July the 12th, and it's 6:32 p.m. So just a few slides, just quickly, as I said. So let me admit more joiners here. So it's obviously, I hope everyone who is participating today and joining has watched the futures course, because this is obviously an add-on, and this is basically the practical application of the previously 5 modules that you watched in the library, in the futures course library, right? So this is the practical application part, how to apply everything on the TradeStation chart, basically, right? And so what are we going to do, not only today, but for the rest of the week? And this is basically then a last slide, and then we go immediately into the charting, into TradeStation, right? Because it's, as I said, practical application. So just quickly a review, right? Why trading futures over CFDs? We do this together quickly as an exercise. Why should we trade futures over CFDs? The benefit of futures. And then we go immediately into how to place orders with TradeStation. So there are basically 3 ways how to place orders. We can use the very famous matrix, right? Very fancy way, and it's actually very nice way to place orders. However, it has a downside. We will see that if you look into higher time frames, it might has its disadvantage, but it looks very fancy, very flashy. You're gonna like it. If you have not seen it before, you're gonna love it. Chart trading and the order bar as well. So there's 3 ways how you can place orders. So it's very advanced way. There are a lot of options how to place orders, but we will need only the more the most simplistic. We can use the most simplistic way how to place orders with our limit order, stop loss, and limit target. So yeah, I'm going to show it to you guys. This also today. This is what we're gonna do today as well. And then what we do basically for the rest of the week, and I would really like to take my time here to create a radar screen with you, with front month and back month, that you then always have on hand, that you always can then basically also update, right? Whenever one front month expires, that you can basically update this radar screen, and you have always an updated basically radar screen. But we do the major work today, so you have all markets in that radar screen. And what we're also going to do is, for the rest of the week, and if we need more time, we continue next week, right? Because we have a lot of markets, a lot of ground to cover, because of the newly added or recently added micro and mini futures. I'm going to show you this in a second, and that's why we are doing this futures course basically, right? But I'm going to show you everything in a second. And we're going to look at every single market basically. Let me admit more people here. So we're going to look at every single market and their individual specifications. What do I mean with specifications? Tick value, point value. We look at obviously expiration, first notice date, all these things for each and every market. But also when we look at what I would like to do, if we look at a margin requirements, obviously, for some specific markets, we have to look at the opening and closing time during a day, because not all futures are 24/7 at 24/5 markets, obviously. And for certain commodities that I also will look at the first time, that are kind of new to TradeStation, and or maybe CME has just recently introduced, like oats, right? Some really nice, maybe agricultural products. We do the full scope of analysis and let's see, hey, are these seasonal products? Can we use our tools on these and back test them together? So we have one class where we basically analyze all products now here, from equity indices to treasuries, energies, metals, futures, currencies, softs, agricultural, and meats. So we have literally covered the entire world of futures in this week, and I have no idea how long we need for that. And since we are doing this the very first time, or I'm doing this the very first time, so we might need even longer. Let's see, right? But we're gonna spend a lot of time on this. So so why are we trading futures over CFDs, right? So first of all, I think it's really important at some point of time. I feel like everyone, I don't know about you, but most probably, since we are trading a lot of agricultural products as well, because they're behaving nicely, right? Trade nicely, they're nice seasonal products, they have nice seasonal behavior. So for that we need, most of us need several brokers, right? So some of us need we use equity for forex, for some of the futures CFDs, and then because equity doesn't offer all the agricultural products, you use Oanda or IG, and so it's a mixture of multiple brokers, which is not really comfortable, right? It's just better to have everything, under one umbrella, under one broker, and we could potentially then trade everything with one single broker, right? It's less hassle. It's just more comfortable, right? So that's one advantage. Another advantage is obviously that we the costs, right? With futures, we literally, and I'll show it to you in a second, right? We only pay commission, right? Whatever we trade, we only pay commission. And I think this becomes very interesting also when we trade, and I'll show it to you now. When we trade, now let me remove the PowerPoint. Just here, some gold and silver. We're gonna need this maybe, not today, but looks like they're now recovering from this morning's drop. That's good for us, right? I think everyone is still in gold and silver. Anyway, that should be not the topic now, but trading, when we talk about commissions or fees in general, right? We have the problem that if I quickly go to, I have on the other side of the screen. So if we look at swaps and rollover, right? So now if we trade, for instance, currencies, right? And especially the currencies that have a big difference in interest rate, like for instance, right? Let's take one example, and let's take USD Mexican peso, for instance, right? So here on the left, right? If we look here on the equity swap rollover side, I have also the Oanda side open. That if we want to trade USD Mexican peso, right? If we want to short, that's not a problem, right? Here left is short, if I'm not mistaken. Let me double check. Yeah, left is short, right is long. So if we go short Mexican peso, this is not a problem. We make money every day per standard lot. But if we want to go long USD Mexican peso, right? If we go long USD Mexican peso, and if we look at USD Mexican peso quickly at the chart, right? USD Mexican peso, and I click to the weekly or to the monthly chart, you see here basically, right, that we are in an overall big uptrend, right? So to go long at some point of time here makes a lot of sense, right, on USD Mexican peso. However, if we look at the fees, so going long here, right, on the right side, long, we pay, where now I lost it. Now I lost my friend USD Mexican peso. Where are you? Here. We pay 432 Mexican pesos. So what is that basically? So let me just, I'll Google Mexican peso. So how much is it? 442, right, in dollars. So we pay with equity every day $22 swap interest rate just by going long. So if we have a monthly setup, right, that's a big problem, because if we want to keep maybe a position for several months or for several weeks, and per standard lot we pay every day $22, this can get very expensive, right? And it's not only, of course, with equity. If we look at Rwanda, and I have this open here as well, and if we find USD Mexican peso, here you pay $15, right, if you want to go long. So you always pay for certain currencies a lot of, basically a lot of fees, which is basically, it's interest. It's just interest that you pay, right? It's not really fees, but it's interest that you pay, right? So now trading futures. So now what we would do is basically, right, now the $1 million question. So going long USD Mexican peso, what kind of order would it be in the futures market? So if we look at Mexican peso, what is here the symbol at MP1? At MP1. So let me close. So what would be the so a long in the Forex market would be equivalent to what in the futures market? A sell, a short. Right? Perfect. Is this clear for everyone? Because this is basic stuff, right? Because in the futures market, just quickly, right? We're gonna cover this when we talk about currency. So we're gonna cover basically asset classes, asset groups by asset groups. So today I'll try to cover equity indices and maybe treasuries, but for sure we're gonna cover equity indices. So on the currencies, so here on the currency futures, we always talk about Mexican peso, US dollar. So the US dollar is always at the end of the currency pair, right? Or and I mentioned that always in the Forex session, or on the Canadian dollar, it's Canadian dollar USD. So in the futures, we can only trade major pairs, and there the US dollar is always at the end of the pair, right? On all of them. So here, so on USD Mexican peso, a long is equivalent with the short, because it's just the inverse picture, right? So now if we would place a short, I'll show it to you quickly how we would do that. Just briefly how we would do that, because we need to prepare this workspace anyway. What I just opened the workspace, and you can do the same, open a workspace chart. And at the same time, I would like to have, I hope you have downloaded this from the classroom section as well, because this is the framework that we're gonna use to add basically the contracts, the front month and the back month here. So this basically, this radar screen we're gonna use for the front month, and this radar screen we're gonna use for the back month. And here we have the matrix, and the matrix we're gonna use basically to place orders. So this is one way to place orders. So I'll just make copy paste here quickly, copy window, paste it here. Put it next to the Mexican peso. We link it, right? So we do a little bit of TradeStation. It's a little bit of TradeStation tutorial as well, obviously. So we're gonna link both the matrix and the chart. How do we gonna link it? Here we link it on the S, on the symbol, So they're same color, so it's locally linked, right? You see it's taking over this symbol now. So what I need to do here on the radar screen, what is really important is that I right click on the black space and I go to settings and I want the quote bar. So I see which symbol because I have to change the symbol, right? Settings. And here basically on settings, matrix, again, we're going to look at this later on more in detail. We can add and remove all these things here on the radar screen. However, everything important should be here already except the quote bar. So I need the quote bar. You see now I have the quote bar, the symbol, last price, net price, and so on and so forth. So so what is now the symbol for, and we're going to talk about just now quickly, again, we're going to talk about this way more in detail in a second. So MP1, we cannot just trade MP1 because you should know this is the adjusted continuous contract. But here I see it's the September is the front month. So I need the front month of the September contract of MP1. So what website do I use for that? We're going to look at this also. This is just now an introduction, basically, guys. No worries. I make this now a little bit quicker. I'll go through this very, 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 very slowly. In a few minutes as well. So the website to go to is bar chart, right? So there we find all the contracts that are being traded, and then also the letter, basically the contract month that you need. For that, you have also the cheat sheet that you can download from the classroom, but we're going to use the website for this in this class. So we go here, we want to go to futures, futures. Then we go to currencies. Here are all the currencies listed that are being traded in the futures market. Here I have the Mexican peso. So I know Mexican peso September contract, right? So it's the U contract. You see here, it's the U contract. So it's the U contract on the Mexican peso. Now let me type this in quickly. As I said, this is now MP. So it's then the contract name MP1 U21. We do this all slowly later on. Click enter. Now I have now you see the price is the same. You basically see also now here, why do you have these dots? Now you see that because we now look only at the single contract. It's basically, it gives you the life cycle of the contract starting and so far status quo, current date, right? Before that, there was no trading activity. The contract was basically alive, the life cycle, maybe it was basically it started already to trade, right? It started already to trade, but there was no volume because nobody was trading this particular contract during this period of time, right? They started to trade MP1 U21 later on, and then you see basically the candles appearing, meaning the liquidity and the volume is showing up. So now, what did we say? It's an equivalent order to a sell, right? So now let's just blindly quickly place a sell with a matrix. And this is very simple. Let me just quickly place a market order, sell one contract, market, and I just click sell market. So I'm in a simulator, obviously. And I'm just encouraging you, because it's nicely now to practice also placing orders with a matrix, with the order bar, with the or chart trading. We're going to do everything today, and you're going to use what is most convenient for you. Some people, they love the matrix. Some people are just a very, let me call it more like old school. They use the order bar, or chart trading is also very, very convenient. But it's more like about what you personally prefer, right? But I just can encourage you just to play around then also and try, right? And just randomly place orders. So now I'm in a simulator, nothing can happen, obviously. Now I'm just selling a market, right? I'm just selling market here. This will show up. I can remove that, but it's just reconfirming if I want to place this order. Yes, boom. Now I'm in that trade, right? So you see, and you see already a few things, and we're going to look at this also in a second. Now, market order was here at 0.04994. So you see the tick value here already popping up. But we're going to talk about this in a second. So I have my stop loss, my bracket order here automatically placed as well. We're going to look at this also in a second, more in detail. But my point is now here that I just sold one contract short. Now I'm going back to my matrix, and I see now here on this window that, do I see that here? Ask bit, open P&L. So I basically that I don't have total cost. This is my margin requirement. This is the market value basically. So this divided by this is my leverage. Why I'm not in the trade anymore? Did it already? It's because I'm still in the trade, but it's zero value. That's why it's so. But I thought I'm going to see here in the simulator, open P&L, the fees per contract. I thought so. I'm going to see this as well. Do I see this up here? Let me check here. Yep, here. You see commission. So per contract, you see it's even calculating in the simulator. So all what I paid per contract now, it's $1.20. So if I close this position, I pay another $1.20. And you see that now already the advantage if you want to trade, for instance, the Mexican peso long. If you trade one contract, I'm not sure if one contract is equivalent to one standard lot, most probably not, but it doesn't matter because here you never have swap fees. You can now stay in the trade as long as you want, or in other words, until the contract expires, and then you can roll over and then you pay another $1.20, right? And the $1.20, regardless of how many contracts you're gonna trade, if you trade one contract, 5 contracts, 10 contracts, the commission is always neglectable, basically, right? So huge advantage futures over, right? Just to showcase you the swap advantage. And if we again go to, now let's close this position, right? So let's close it. I click to close. We're going to talk about the very famous reverse button as well that you never going to use most probably in your entire life, but I don't know why it's there, but let's just close it. And the position is closed, right? And the position is closed, and I see this here now as well. And I paid another $1.20. That's always it with futures, right? We're gonna get to that. The risk here is not 1,000, 5,000. Sina is saying, I have to say that for the recording viewers, Sina is asking, the risk here is around $1,500 per contract. If you don't have a stop loss, then it might be the risk, yes. But if you have a stop loss in place, right? So that's not the point, right? That's the margin, and the margin requirement. We're gonna look this up. What's the margin requirement for the Mexican peso as well per contract? But basically, if you look nowadays, right, that you pay swaps everywhere, right? And even if you want to trade just the euro US dollar, right? If you want to go long the euro US dollar, you pay $5 every day per standard lot, right? Which is, if you trade them on futures, again, you only pay commission. So I think it's a huge advantage. One advantage is that if you want to trade longer term positions that we ideally always do, right? that these major pairs are being traded in the futures market. However, now we can talk about the disadvantage as well. What's the disadvantage? You will never in the futures market get as much leverage as in the Forex market. It's just for non-product, right? So we can get on the euro US dollar up to 500 to 1 leverage, right? So in the futures, you get maybe 50 to 1 leverage, right? Or 40 to 1 leverage or 60 to 1 leverage, right? But at the end of the day, do we really need 500 to 1 leverage, right? That's the question, right? Our account balance should always be, our account value should always be somehow in line with the risk that we're going to take, right? If we have only $10,000 available for trading, if we literally have only $10,000 available for trading, we don't want to take $5,000 of risk or $4,000 of risk per trade, right? If we have only that $10,000, right? If you have $100,000, it's a different topic, but right. So that's why it should always kind of, one should match the other. So that's why 40, 50 to 1 leverage should be actually enough, right? So that's one advantage. And as I said, maybe one disadvantage, because we never get that amount of leverage in the futures market for non-products, for none of the products, right? So what did we cover so far? So the advantages of futures, right? Everything under one umbrella, one broker, less fees. Let's consider a swap as a fee, right? Less fees. You only pay per contract being traded. No, you don't pay interest. You don't have rollover fees, right? It's just really always per contract. And I think another major advantage is that saves us a lot of hassle, is that we literally can trade the chart that we are looking at, right? What we always do is, one thing is that we look at silver, for instance, and okay, price is here 26.38. So now it's moving nicely. It's here. So now we look into the CFD charts, and then we see a difference between the CFD chart, and the CFD chart is maybe 10 points lower, 10 points higher, and then we have to subtract and add these 10 points, and we are not really sure if we place the order correctly, because we have to compare the real deal with like a derivative, right? The CFD futures, that's why we are using, that's why I personally like always for these CFD futures, I use equity, because there we have the closest possible derivative, right? CFD futures. Why is this the closest possible derivative? Because they have a direct connection to the exchange. They get the quote from the Chicago Mercantile Exchange for silver, for gold, for these CME products, and then they derive basically the price themselves, and they use basically the equivalent to what is actually offered in futures. That's why it's the closest possible derivative, but still it's only a derivative. And you have basically, right, if you look at you have a spread in there, right? If I want to place an order on silver here, it's another advantage. You basically don't have a lot of spread, depending on the volume, depending on time of the day, right? But if you want to get now this price, if you want to get, you have seen it on the Mexican peso. Now it's on for all the products. If I now want to sell on at this price, I can click here, sell it. Boom, I'm in for that particular price. Not one tick higher, not one tick lower. I'm in for that price. There's literally no spread involved. And this is what you can do for each and every market. So you save on spread as well, right? especially you know, for the commodities, you always have a big time spread, right? So another advantage that you don't have spread, you always get filled for the price that you want to get filled. I wanted to get for this uh, wanted to get filled for this price, so I got filled, right? Exactly on that tick, right? So let me close again. So, and yeah, as I said, we can literally, it's very convenient, and we don't have to compare CFD derivative with the real chart, and then we have to adjust our order. We just place our trade on TradeStation on the real deal, right? I think we have a lot of small advantages, but I think to trade the real deal and not like bother with the derivative and not bother with the different pricing and with and adding spread, deducting spread, I think as a professional is a big deal, right? In the beginning, if you take a few dollars risk here and there, you don't necessarily have to don't go do that, right? But once you are more professional, I think this is a big deal, and this is should be done. So now, previously, obviously, there was a problem, right? And the problem was clearly, and this is what we're going to look at now, was margin requirement, right? So when I started off trading, just a little anecdote here. When I started off trading in early 2015, right, January 2015, right, the margin requirement for the Nasdaq was $4,000 per contract, $4,000. So 6 years later, 6.5 years later, it quadrupled, literally even more, right? It's insane, right? And where in 2015, where Nasdaq was considered a market for beginners, now this is a market only for professionals because of the volatility, right? We're going to see this in a second, how this on the matrix, how this is moving up and down, up and down, up and down. It can be insane, right? And you should have seen the matrix going up and down during the crash in the Corona crash, right? This was the system was not even that fast to could catch price on the screen. That's how fast price was moving. Now, and this is not only on the Nasdaq, it actually increased tremendously on all these products, which made it very unattractive for people outside the US to trade. And by the way, CFDs are not for people in the US. You have to trade futures. CFDs are not allowed to trade in the US, and it's very self-explanatory. Why, right? Because if CFDs were allowed to trade in the US, exchanges like all the retail traders, they would move from real futures, or they would have moved from real futures to CFDs because of the lower margin requirement, because you need a shitload of money, right, to trade a little bit of a few contracts here and there. You need $100,000 account to make a little bit of ROI on these futures, right, to trade a contract here, contract there. And you need $50 to $100,000, right, previously, right? So outside the US, almost nobody is trading futures because everywhere else in the world you can trade CFDs, right? So obviously now, or just recently, they introduced, because they realized that as well, that hey, we don't get volume from outside the US, and only people from the US are trading futures because they're not allowed to trade CFDs. So now they started to introduce micros and minis. And this is the point where it started to get attractive for us as well. Micros right here. And then you see now, And in the very beginning, when they introduced it, I was very skeptical still, because we're going to look at the volume as well. Because when they introduced it, there was no volume, right? So the chart looked like almost like the Mexican peso here as well. No volume, no candles, right? So how do you trade something with no volume? Impossible, right? So now these products, and we're going to look, I haven't looked at all of them, but I looked at the, where's now my, where's that window? Yep. I looked at the micro indices already, and they have a good amount of volume, actually the same amount than the e-minis, and I was quite surprised about that. And now this makes it really attractive for us to trade as well. So what you all also have to do, obviously, is then compare, hey, is it worth for me, taking into account, we're going to look at, because from top of my head, right, I don't know what's the tick value on the micro S&P. Yes, we can find it out. We can look at the CME. We can always look up the specification, and I'm also going to show you how to look up the specification for each and every product, and they occasionally change as well, right? These specification can change, especially the margins. They can change like every quarter here and there. So this is something, that's why I think I never specified these margins on the cheat sheet, because I was literally tired to update them, because they really change, right, every quarter here and there, right? Sometimes up, sometimes down, but most of the times they just go up. And however, something that hardly changes but can change as well is the tick value. It can change, but it hardly changes. All right. So now we have here now the micros, and we can look the tick and point value up on the on the specification sheet. But I'll on the specification sheet where do we find the specification sheet? On the exchange website. So the equity indices are all, as we know from the course, CME based, right? Chicago Mercantile Exchange based. So there we find the specification sheet, but we can make our life much easier, and we can just, I'll show it to you in a second. We do what we just did on the Mexican peso. We just place an order, buy or sell, one contract, market, and then we see what's the tick value. And then we can also look at the point value, and then we can write it down, and then we have the point and tick value. And then we can see whether this is worth it for us to the next trade, to say, hey, for you, I rather trade the real futures versus some kind of derivative, because I pay daily fees, I have a CFD product, and so on and so on and so forth, right? And it's up to you to evaluate whether it's worth for you to say, hey, let me trade here the real futures, or I stick to my CFD. Nothing is wrong with that. Don't get me wrong, right? You can stick to the CFD. You have maybe most probably more leverage, right? But then you have to go through the adjustment, price adjustment, right? Real deal versus CFD, daily rollover fees, maybe spread, price adjustment, and so on and so forth, right? Because anyway, we have to analyze the real product, and the real product is always this is always the underlying asset. But we're going to look at this now together. So we're going to look today, right, at all the equity indices here, and what they recently introduced as well. And look, I mean, trading Bitcoin, there's no point of trading Bitcoin, right? A margin of roughly $63,000 initial margin, right? We always have to look at the initial margin, obviously, also something that we cover in the course, right? That we covered in the first 5 modules. But now just recently, really recently, right? They introduced also micro Bitcoins, and now it makes even sense, and we have to look at the volume. I haven't done this yet. We're not going to do this today. Cryptocurrencies we keep for the very last session, right? Whenever this is going to be. We're going to look at the micro Bitcoins and see if this has enough volume for us already to trade on the futures, and how the chart looks like, because this would be really attractive. So I'm just going to go through the list and show you what we're gonna look at, right? And how we're gonna group our sessions. So today we're gonna look at all these products, right? And we can even look at the wicks, right? We're gonna see how we plot the wicks, right? And how we can trade the wicks, right? And what is the wicks, right? So we're gonna look at this. So now the German markets, Eurex, we're not going to, I think there's no point of still, you have now even mini DAX and you have the micro DAX. So this would make, and a lot of treasury bonds would theoretically make this really attractive for us to trade also. But as far as I'm concerned, I have to look this up again. But I think the live data for the Eurex, I think it's roughly $100 per month, if I'm not wrong. I know the delay data, but we cannot trade with the delay data is I think $10 or so, $10. But the live data, if I'm not mistaken, is $100. We have to double check that. If this is $20 or so, we're gonna subscribe to that. We're gonna add this into the class, because then we have more products to analyze and more products to trade, more opportunities, right? Because the DAX is nice to trade, but if the real data is $100 and we have to subscribe that, that's not worth it, right? Because there's another exchange that we have to consider, that is ICE, right? The International Commodity Exchange. We have to consider this as well, where we can trade sugar, and I think this one is $100 as well. So you would have the Eurex and the ICE, which then you pay every month $200, just as that you get the subscription from the. And this is basically, that's what the exchange is charging to the customer. So it's charging TradeStation, and they're just transferring the fees to you, basically. All right. So which doesn't make any sense. However, I would say if we look at the ICE products, how many products are available on ICE, because sugar is, I think, only on ICE. If I'm not mistaken, I think they introduced something on CME as well. I'm not sure. We're gonna look this up when we talk commodities. But if I had to subscribe to one of these exchanges, ICE or Eurex, I would definitely go for ICE, because sugar, right, crazy seasonal, up and down, right? This is something that we're gonna trade throughout the year, definitely. Or we have trading or let me call it potential trading opportunities throughout the year. And this is something that I would definitely then, because so far you have traded this on Oanda, and you should know that this has you pay a lot of daily rollover fees on Oanda for sugar. Here again, only contract. I pay only for the contract, so I think here it would make sense to invest these if you pay a decent amount of, if you have a decent contract size. If you have a proper risk in place for these trades, to subscribe to the ICE data and then trade sugar on the real exchange, right? So Eurex products, most probably not. So, and then we move to the currencies, and currencies is also CME based. And here we have also minis and micros. And look at if you just look at the micros now, right? And look at the margins, it's really like nothing, right? Even the full contract is already super small compared to what you pay for the equity indices, right? You have also you have also a higher margin, obviously, per real standard lot in the spot forex market. But now if you look at the mini and the e-micros, right, this is really this is really funny, right? So you can really, like, with even a $500 account, you can trade these e-micros, right? We're going to look at the currencies next time, and we have the interest rates, right, that we also look here. Basically, look at this. We have three interest rates that we're going to look at, or we have one treasury bond, the 30-year bond, the 10-year note, and the 5-year note. I've never looked at the 2-year note. We can do this exercise as well. But ultimately, you see here anyway, they're very much all correlated anyway, right? I don't know, as I said, 2-year, we have to look at the chart, but the 5-year, 10-year, 30-year pretty much correlated, as you know, right? If one goes up, all go up. If one goes down, they all go down, right? Pretty much, right? So if you look at the 5-year, for instance, and look at just the margin requirement, so very low margin requirement on these treasury notes and the bonds as well. However, you have high tick value there, but we're going to see this, right, and analyze this together. Now, to our friends, are they treating us nicely today? Are they treating us nicely today? I hope so. Gold, silver, high margin requirement, super high margin requirement, right? So, however, now they introduced micro gold and micro silver, where you see micro gold now. Wow, it makes all of a sudden, maybe for somebody who has a smaller account size and also taking therefore smaller risk, makes a lot of sense to trade gold with micros, right? Depends, right? And then you have to evaluate whether you want to have still that 100-to-1 leverage bomb, or we're going to see what's the tick value here. We have to place an order just to see what's the tick value. You have the minis as well, but you see always here in brackets the exchange basically. So COMEX in New York, NYMEX, this is all falls under CME, right? This falls all under CME. And this is then the ICE basically, but we don't want to trade. We don't want to trade. If you have done the subscription, the ICE subscription, right, for gold and silver, then you can trade this here as well. But I would always stick to CME metals, because also volume is much higher there. So then we cover the energies. We have now on the energies, right? We can trade. You see here, crude oil, basically, and we have the E-mini crude oil. We have heating oil and E-mini heating oil. Heating oil also very nicely seasonal product as well, that we can then cover if you trade something that you don't find. Actually, I think you don't even have this on IG. Has, I think, the most broad spectrum of products. I think heating oil you don't find nowhere. So here we can also trade heating oil, very nice product, or gasoline. So and there, if you trade natural gas, crude oil, you have half of the margin requirement now as well. Now we get into a very, 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 I think, very exciting and very exciting, and I'm very looking forward to analyze these products with you, right? I already took a glimpse at oats, right? And I can already tease crazy seasonal, and the seasonal pattern and the indicators work perfectly on oats as well. Something we can add, and you look at the margin requirement, it's really nothing that everybody who's trading should be able to trade oats, right? So, and you have soybean oil, meal, rough ice, whatever that is, right? This is new as well, milk and butter, and I was actually already trying here because I was very curious how the chart looks like for milk and butter. I was not able to plot these because this is the symbol, right? You would just do, if you get wheat, you just do at W, right? Or if you want to have corn, you just do, if you want to have the unadjusted, if you want to have the adjusted continuous contract, you just put an at symbol before that, symbol here, right? So at W, at C, at O, right? And at O works, but I tried at DA and at CB, and for some reason, TradeStation doesn't recognize this, but this is the TradeStation website. So I don't know what's the deal here. We will find that out once we get to the agricultural session, right? And then now, as I said, we have meat, we have wheat, we have corn, we have soybeans, but we have now mini wheat, mini corn, and mini soybeans as well. And then look at the margin requirements. Now we have, and you see now we have now, we can already tell that now the US very smartly, they realize that with these throughout the years, with the slow increase, or with the tremendous, not slow increase, with the tremendous increase of margin requirements, they actually pushed away the retail trader to find, right, to go to other markets, or to find to trade through Robinhood and stock options, and here other derivative products. And now they slowly increase for all of their markets. They introduce these minis and these micros, and this makes it slowly now, of course, I guess, I hope, also for us, right, more attractive to trade the real deal and have more trading opportunities. If you look at these agricultural products here, we can now trade the meats. And if you looked at, some of you guys traded the meats already. If you look at lean hogs, live cattle, and fodder cattle, crazy seasonal lows, crazy seasonal highs, nice opportunities here, considerably low margin requirement, something we should consider to trade as a professional. As a professional, you should consider to trade this as well, right? Again, in the beginning, don't get overwhelmed with all these products. You don't have to trade all these products, but at some point of time, if you become pro, you should take these opportunities here as well. And then, as I told you, now ICE, right? These right, they're charging $100 for per month per exchange subscription, which is not. I mean, look at CME. CME is basically for free. CME data and ICE for these few products, they are charging $100. So that's not really fair. But what to do, right? But they have nice products, right? Coffee, cotton. We can look at frozen orange juice as well, cocoa, and our friend sugar, right? So it's something that we should consider, because there are definitely trading opportunities here. And then trading the real chart, right? And you know, some of you have tried trading coffee and cotton through like a different CFD brokers. The charts are horrible, right? The spread is crazy, and the charts never look like the real product, right? So it's much more comfortable trading than the real product in the future here. I would personally suggest. So that's just the overview now to show you what we going to go through, right, in the next 4 days. And I'm not sure if we can cover all this in 4 days. So we gonna spend as much time as we need for all these products, so we have a nice overview of how to trade them and analyzing them and so forth, and so on and so forth, right? Perfect. So I hope you guys are excited. So now, what are we going to do next? So let's look at how we going to place orders, right? I teased it already, but we're going to do this very slow. Okay. So what we're going to need first. So let me open now. Let's start with quickly with the S&P 500. So just, we have also September contract in S&P. So so how would you know that? Again, always, if you want to know which contract you are, which basic, not, let me rephrase. If you want to know what is the actual front month, yes, you can look at, that's not, you can look at bar chart. I'm going to show you how to do this as well. But the easy way is you do at ES. If you want to know it for S&P, you look at the adjusted continuous chart. You see it's September. You have it here in brackets, right here in brackets. So you know September contract is U. So the symbol then obviously is, now I have to click here on them. I don't have to click up here to the symbol. I just, the trade session just has to know that I'm somewhere here on that matrix. So I click S at, not at, sorry, ES, the symbol, the contract month, the year, enter, and it opens, right? Now how to compare that? I have the real, the real price you see here. Let me not link it. So just to show you something. So I removed the linkage here. Let me put here again at ES. Now here on the chart, you see here on the chart, I've plotted the adjusted continuous contract, and you see here this. We are in the front month of September, and here I have the front months plotted because I cannot place a trade on at ES. I have to always place a trade on the contract. We know this from equity, right? On the derivative futures. Now placing a trade on silver and gold, you have to place it on the contract itself. So here now you see, since the price is in line, you see that, you know that you're correct. If that price here was different, to the chart price, then you know something is wrong, right? Because it has to be the same, because here's the front month and here it's the front month, right now. Clear? So now, if I want to place a trade, let me now quickly go through the matrix here, details. So you have here the trade bar, right? This has to be always open, the trade bar. Here, order type. Very important. It is always on automatic. Limit and stop loss market. Never put it on stop loss and on stop loss limit. You want to get out at market, not at limit. You want to get out once the price. You know the I don't want to go through now the difference between market order and limit order. You should know the difference, right? This is very basic stuff. If you're trading, right, you want to get out at market, right? And STP stands for market, and not STL stands not for stop loss order, right? It's stop loss limit. So you want to do the market. So this should be presetted, right? As STP, right? You should make sure that you're with a simulating account here. And then quantity, this is the contracts, right? 1 contract, 10 contracts, 5 contracts, whatever you contracts are trading. Duration, right? Good till cancel, good for the day, blah, 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 whatever. Usually you have day or good till cancel until the order is in. And basically, most likely you should put it in GTC, good till cancel. So the order is in the market until you personally cancel it. So now you have if you go lower, you have here attach OSO. So this is very important, because this should be always clicked. What is OSO? Order sense order. So this adds your bracket order. What is your bracket order? Bracket order is your stop loss and your target. So if you don't have this attached, and if I now just press an order, I have just an entry, but I don't have a stop loss and target. I can add this afterwards as well, but you should always have this included in the beginning, because you should obviously know your risk, and you should know your risk, and you should know your target potential, right? So you should always have to add this. So now attach this. Now you can, what is important, if you use the matrix, right, you can now not, and this is the disadvantage of the matrix, I would say, you cannot here specify the, you can potentially, but you cannot clearly say, okay, I want to have my stop loss at price X and I want to have my target at price X. It will add somewhere on the chart, will place your stop loss, and it will somewhere on the chart place your target, and then you move it manually with that matrix tool. I show you how to do it in a second as well. What is important though is if you click here on these three dots, that you change the price offset where it places the target and where it places the stop loss. Meaning now it's the price offset is 10, meaning when I enter now at market, it places my target 10. If I now buy at market, it places my target 10 ticks above my entry and my stop loss 10 ticks below my entry. So 10 ticks on a day where you have high volatility, this is, you cannot react so quickly to move then target and stop loss, that otherwise it might hit then automatically your target and your stop loss before you basically moved it manually. So your offset should be always, can I just type it in here, 50 years, maybe 50 ticks, so you then have enough time. It cannot just, you have enough time to move your target and your stop loss manually. So I think this is the only disadvantage of the matrix, that you can then just manually have to move your target and your stop loss set as default as futures. Yeah, let's set this as a default, that you basically now have to move it then manually, the target and the stop loss wherever you want to have it. I'll show it to you now. So I click OK. And then obviously here you can differentiate again. SL is stop limit. You never want to have the L. You always want to have the market stop losses, right? So you want to get out when it hits that market price, right? On a high volatility day, this is important that you get out at market and not at limit, because it can jump basically over your limit and you can never get filled, or there could be a gap or whatsoever and you never get filled, right? For the stop loss. So you can have one targets, two stop losses, two targets, one stop loss. I've never worked, right? It doesn't, two targets, two stop losses, three targets, one stop loss. So now, very important, right? If you trade one contract, you cannot have two targets, right? If I want to have two targets, I need two contracts. So I can only now, with one contract, I can trade one target, one stop loss, right? But this is stuff that you basically have. That's why you have the simulator for. You play around with that, right? And see how it works. So, and then you have place OCO. This is, so order cancels order. This is what you need if you forgot to place the OSO. If you just place now market, right? We're going to simulate this all together. So this is most probably what we do until the end of today, order placing, and then we go through the assets tomorrow. Let's see. Because now, if I forgot to place, attach the OSO, I can still add my bracket later on with the OCO. Okay. So if I now have let's assume for now we do everything right. I'll attach the OCO and and now I don't have to buy market. You see now with my cursor, I hope everyone sees my cursor. So now I'm now on the blue bar here. The middle, so you see here, the column in the middle, the bar in the middle is the current price, is price. Here on that gray line, this was the high of the day. And somewhere down here, do I get the low of the day, right? Everything that is black here is that today's trading range, right? And everything that is great. So this would be the high of today, and below would be the low of today. So now the volume here, this shows the trading volume per trade station, but this is not really significant, and you don't have to bother what's here and how this is flashing up and down, higher, lower. You couldn't care less about these numbers here. So now if I want to place a limit, so waiting for price to come to me and I want to buy, I go to the blue bar, and you see here, it automatically, if I go below, it goes, you see how it says limit, buy one limit. If I go above current price, buy one stop market. So this would be basically a breakout order, right? Buying higher than current price. And if I go below, the system automatically recognizes, hey, I want to buy one limit. And the same for stop loss, right? If you say, okay, let me wait for price to come higher and then short, if I go above current price, it shows sell one limit. And if I go below current price, it says sell one stop market. So it's basically a breakout order, right? If you have basically a daily bearish engulfing and we say let's short below daily bearish engulfing, you would say I want to place my order below daily bearish engulfing, and you would place here. So how this now works, if I want to place a limit buy order, right, I would just say, okay, I want to buy here at whatever price here is below current price. Click here once, it asks me blah blah blah, are you okay? I can in the future say, okay, I don't bother about this message. Click okay. And then now it placed my buy order here, right? Now it's important. So now where's my stop loss? Where's my stop loss and where's my target? Where's my stop loss and where's my target? 50 ticks, right? I put it far away from current price, because look at this now. Imagine if I had left the offset at 10, it would have put the stop loss, the target somewhere here and the stop loss somewhere here. So I would have gotten nervous and oof, if I get filled right away, let me move my target and my stop loss very fast to basically not get filled basically within the same minute, right? So now you see, here's my stop loss and here's my target. So now I can basically go here and say, click here, it's now track and drop. And this is the beauty actually about the matrix, that I just say, okay, here's my target. I track and drop and say my target should be here. Confirm. And I then can adjust my stop loss manually, say maybe my stop loss should be here, right? I'm just making this up. My stop loss should be here. So now I have my order placed, right? And my order, then you always see here, if I go back to that workspace that you can download from the classroom, that you have here your order placed, and then you have all the details where the order is placed, blah, blah, blah. So now my order is placed here, good till cancel. So now let's get, now what is very important, this was one of my first rookie mistakes I've ever made. I don't want to tell the story because I don't want to waste time. We spend already so much time on that stuff. That never do the following. If you want to cancel this order, click on cancel all. Click on cancel all here. Then everything goes. Don't click on cancel single order, because then it really cancels only the single order. That was one of the most, this was my first rookie mistake I made trading live gold. I remember this until today, where I just thought, okay, I cancel my order. I just cancel, and I was trading live, canceled one contract, one full contract, canceled my stop loss here, but I wanted to cancel all my orders. I thought I canceled all, but I just clicked on cancel stop loss. So what it did, I just canceled my stop loss. So I got filled. And then a few hours later, I checked and price was going against me, and there was no stop loss, right? So that's so if you want to cancel it, cancel all. Don't click on the single orders. So now let me try to get filled. Let me get close to current price. Closer. So now you see I have my order at 4367, 4,367. So now there is no spread involved whatsoever, right? So if price comes down, I'll get filled. I just want to simulate this now to you guys. So now I got filled exactly for this price, right? So now I'm in that trade. So now you see the following. What's the tick value on the S&P 500, ladies and gentlemen? I ask you guys, what's the tick value on the S&P 500? No, Alex is wrong. François is right? The tick value, tick is the smallest increment. Exactly, Renee, perfect, yeah. The smallest increment is $12.50, right? Is $12.50. So every single tick with one contract up makes me $12.50, and every single tick down, I lose $12.50, right? So now let me put my stop loss here at $200, and let me put my target here at $200. So you basically now see, okay, one tick is equivalent to $12.50 up and down, right? So what is the point value then? And this is where Alex was confused, and this is now this is the point value, right? So you see from, for instance, from 4367, what's the movement? What's the increment movement is 0.25, is 1/4 movement. 0.25, 0.25, 0.25, 68, 1 point. 25, 50, 75, 69, 1 point. So you know now that your tick value, your point value, so four ticks, right? 4 ticks equals 1 point. So now you see I was just up 4 ticks equals 1 point. So the point value is 4 times $12.50. So it's $50, right? A lot, right? This is a lot per full contract. This is a lot. This is a lot per full contract, right? And if I look at the chart, let me look at the 60-minute chart. I placed my entry just to demonstrate 367, and my stop loss. I put my stop loss at $200. So what's the $200? 3635. Let me go to a 10-minute chart. Come on, where's the 10-minute chart? Let me go back to daily. Let me go to 15-minute chart. Oh, it's so tiring that these charts load so slow sometimes. There you can see that I've never loaded the 10-minute or the 15-minute chart before. Anyway, I think it's anyway the best to showcase is a 60-minute, but it's the best to showcase the, on the daily chart anyway, what I wanted to show. This is the daily chart, and look at the size of my level. Look at this mini area that I've just placed that trade. And that value of that mini area, the value, the risk that I have here is $200, right? So imagine you want to trade a weekly zone. So that's literally a $200 zone. So imagine you want to trade a daily zone like this. And then you can calculate the risk basically you would have here based on a full contract, right? If this is $200, then this is most probably $4,000 per single contract, right? So, which makes it kind of, for most normal traders, especially beginners, very unattractive to trade a full contract. And that's why we then gonna go to the minis and the micros and see the difference, right? So again, to summarize here, and we do this for each and every product to see what's the tick value, what's the point value. You basically can evaluate this yourself by placing a market order and see, okay, hey, what's my, with one contract, and then you see the smallest increment. You see it here on the right. This is my tick value, and here it's very simple. What's the point value, right? Your point value, then here's 4 ticks equals 1 point, and then you have the point value, and then you can calculate, hey, if you want to place now snap mode, so how many points is that? Let's do quickly the math, right? Let's do quickly the math. 4113 minus 4046. This is how we would then calculate. This is how you would then calculate your always your. Let me remove the snap mode. This is how you would calculate the risk size, right? So it's 113 minus, so for now 1446, right, equals how many points? 67 points. What's the point value times what's the point value times 50, right? Times 50. So 67 times 50. So your risk on this is basically, so the risk on this is 3,350 US dollar. Plus, you see here you have 2 ticks remaining, right? I was just using 113 plus 2 ticks and $25. So $25. So plus 2 ticks equals 3,375 US dollars. So that would be your risk per contract here on that daily zone, for instance, for a standard contract, right? Is that clear, right? And you have, this is how you calculate it then for each, and we're gonna do this for other products as well, but this is how you would calculate your risk basically for, and then you would place it basically, right? So now if I just close it here, does this make sense for everyone? It's very much straightforward, but we're going to practice this more. So on the matrix now placing this order, this would be a little bit of a hustle, because 113, you would need to scroll, you see, all the way down. You see that? You have to scroll all the way down to find 11141. So this is the problem with the matrix. You see? So matrix, nice and fancy. We like how it's flashing green, right? It's very, most probably you're staring only to green going up and down. It's very addictive, I can tell you that. Especially if it goes quickly in your favor. The red is not so funny, but it's really yeah, it's just a fancy way how to no, you cannot change here on the matrix, not, but we're gonna find different ways how to we're gonna use different ways how to place orders. So to place a trade that is far away on the matrix is not really convenient, right? It is really a headache. By the way, just to show you quickly, if you forget to place an OSO, and I just buy one market, now I have an order in the market without stop loss and without target. So now you could just say place OCO. And it says also estimated commission. You see $1.20. And you see it has now attached my brackets orders as well. And here you see you can change the offset as well. The offset is here still at 10. And you see 10, now the price is not moving really fast today at this time, but 10 ticks can be, if you have high volatility, it's just not enough, right? Just to, because you have to move your, you see you have to move your stop your target higher and press yes. And believe me, if the market is very volatile, the system can is lacking in speed, and then you have to move this down, and then you're really getting freaking nervous, right? So the matrix, if you want to, it's nice, I would say, to place like orders if you just quickly want to get in, right? If it's a short below, long above, something like that, or if your entry is very close and you just, okay, my entry is close by, I just buy a limit. But if you want to place the order that is far away, it's not really convenient, right? It's not really convenient. So let me close, right, the position here as well, and let me show you another way how to place that trade. And then it's almost 8. We have to, it's then 1.5 hours. We continue then tomorrow. I hope you're gonna join tomorrow as well. We're gonna do this. I just quickly gonna tease that chart trading part, because I have another meeting at 8:30 today. So I have to prepare that as well. So you see here, you click on the chart and you go to chart trading. See, click on the chart, right mouse click, chart trading. It opens and it tells you, don't display that at startup. Again, it asks you, we keep that for now. It tells you how to place trade. So for longs, it's control left mouse button, and for sell short is alt and left mouse button, right? Very much straightforward. Control left mouse button, and for a short it is alt and left mouse button. So if I now want to place an order, you can also, in here you can play around, enable keyboard trading. You can also go hotkey that you just place like E for enter, whatever. Like you can go really fancy on that. You can just play around in your on your chart in the simulator. But why do I have still here on the matrix these bracket orders? So let me remove them as well. So if I want to place this now, right? Remember, for a buy order, it's I cannot literally show it to you, but you press Control, you hold Control, and the left mouse button. Account invalid. Yeah, of course. My mistake. Why? Okay. Why does it say this? My mistake. Why does it say invalid future symbol? Perfect. Yes, yes, absolutely. I cannot place an order. Yes, exactly. Stupid me, right? So I have to also here say at, not at, ESU 21. It shows me here my previous orders that I just placed randomly. So it's what you want to do before. You want to highlight the zone where you want to place the order. So let's assume you want to place a set and forget on this demand zone, right? So I press Alt, Control, sorry, and left. I forgot. You see here, always check everything. Attach OSO, very important. Bracket order, one limit, one stop loss, perfect. Press Control, left mouse, and it asks me yes. And I have my order in here. Also here, I can only adjust the offset. But now what is so nice about chart trading, I can now move this one, this my stop loss, where I want to have it, and my target where I want to have it. Much more convenient, right? And now my order is placed. Before that, obviously, you have to place obviously you have to calculate your risk and so on, how many contracts you can trade, blah blah blah. But we're going to do this tomorrow. But placing an order here is then very easy. So if you say you want to short for whatever reason, you want to short at 4,400 at that round number, want to put your stop loss at 4,500. Now you don't press Control, you go above price, so the system recognizes you want to go short. If you press Alt, and then again left mouse button, I move my stop loss higher, my target wherever I want to have it for big short, right? And then I have my short placed as well, right? And I find these again here in these the order summary here of orders. Absolutely, yes. You can also do that if you do exit stop only. Now we have one target, one stop loss. If you do stop only, then you have stop. You can play around. Cool. So longer than expected, as usual, when I have the sessions, right? Hard for me to time it if I start talking to you guys. Yes, and we continue doing this tomorrow, right? So this was only the beginning. Obviously, we're going to go more into depth in the single contracts and markets and so on and so forth. But I hope this helps everyone also to figure out then how to trade on TradeStation. Okay, guys, we basically continue exactly where we're stopping today. I leave these orders in the market, so we play around there a little bit. And yeah, I'm going to show you one more way with the order bar, how to place orders. And yes, for you, basically, it's just already, you know now how you can play around with that, use the matrix, use chart trading, and you can already get used to that. Okay, cool. Then I see you guys tomorrow, same time. Thank you for joining that live trading session, for all of you guys coming. Really appreciate that. Really appreciate that. And I'll talk to you guys tomorrow, same time. And then I'll be earlier again, and then we look at gold and silver and see what they are doing for us. Okay, cool. See you tomorrow, guys. Bye-bye.